Hi, I'm Elliot Vance. After years in the markets, one thing I've learned is this: portfolios don't drift by accident. They drift because markets don't move in straight lines. Today, let's talk about rebalancing, not just what it is, but when it actually makes sense. At a basic level, rebalancing is straightforward. You start with a plan, say 60% in stocks and 40% in bonds. But if stocks outperform, that allocation might shift to 70% without you doing anything. Rebalancing simply means trimming those winners and adding to underperforming assets to get back to your original structure. So why do investors rely on it? There are two main reasons. First, risk control. When one asset grows too large, your portfolio becomes more concentrated and often more volatile than intended. Rebalancing brings that exposure back in line with your strategy. Second, discipline. It forces a behavior that's difficult in real time, selling assets that have already gone up and buying those that haven't. In theory, that aligns with buying low and selling high. But here's where things get more nuanced. Rebalancing comes with a trade-off. Because every time you rebalance, you're reducing exposure to your strongest performers and increasing exposure to weaker ones. That only works well if markets rotate the way you expect, and in reality, they don't always do that. In strong trending markets, especially bull markets, winners can continue to outperform for much longer than expected. If you rebalance too frequently in that environment, you keep cutting your winners. Over time, that limits the power of compounding, and that can quietly drag down your overall returns. On the other hand, in volatile or sideways markets, rebalancing can be extremely effective. Prices fluctuate, leadership rotates, and different assets take turns outperforming. This is where systematically selling high and buying low starts to add real value. So the real question isn't should you rebalance, but when should you rebalance? There are a couple of practical approaches. Some investors use a fixed schedule, quarterly or annually. It's simple, easy to follow, and removes decision-making. Others use a threshold approach. They only rebalance when allocations drift beyond a certain percentage. This method is more flexible and tends to reduce unnecessary trading. And that brings up another important factor: cost. Rebalancing isn't free. You're dealing with transaction fees and, depending on the structure, possibly taxes. Over time, those costs can compound just like returns do. That's why some investors prefer adjusting their allocation using new capital rather than selling existing positions. Another layer to consider is your time horizon. If you're investing with a long-term perspective, short-term drift isn't always a problem. In fact, over-managing your portfolio can sometimes do more harm than good. But if your focus is stability, income, or capital preservation, more frequent rebalancing may help control risk more effectively. So here's the bottom line. Rebalancing is not a rule, it's a tool. I'm Elliot Vance. And next time your portfolio drifts, don't just ask whether you should rebalance. Ask whether the current market environment actually justifies it. That's the difference between reacting and thinking like a professional.